Hey everybody, it's Justin Spittler here with another quick video update. It's May 18th, 2023. What a day in the markets. The NASDAQ finished up 1.5%, while the S&P 500 finished up 1%. So overall, just really positive reaction. The bears can't seem to gain much traction, and this market seems to be firmly in the hands of the bulls right now. So instead of sharing charts of the S&P 500 and QQQ, which I think you can find all over the place, I'll probably post a chart of those onto my Twitter this evening or tomorrow. But you can find those anywhere. So I want to focus on a few other things in this video. Specifically, we're going to look at some sector ETFs. I want to look at what's really driving the market right now. So we'll look at the tech sector ETF. We'll look at the communications sector ETF. And we'll take a look at other sector ETF that have my attention right now. But before we dive into that, I want to address a concern that I'm hearing a lot of bears echo about the market right now, or at least they have been lately, and that's the market's breadth. So market breadth measures the amount of participation in a rally. So a market with good breadth means there's a lot of stocks rising. A market with poor breadth means a handful of stocks are carrying the market. And so one of the popular narratives recently has been that mega cap tech stocks have been the only stocks rising, and they're just dragging up the market and masking a lot of weakness. And while the mega cap tech stocks are doing very well, you're having impressive outsized performances by stocks like Nvidia, Meta, Google, Apple, Amazon. We're starting to see market participation improve, and it's not just being driven by a handful of stocks. So we can see this clearly when we look at the QQQE ETF. So this ETF pulled back with the rest of the market in 2022, and it actually pulled back all the way to the pre-COVID highs where buyers stepped in and it found support at that key higher time frame support level. Since then, it put in an inverse head and shoulders pattern. I didn't draw the lines here, but you can see it pretty clearly. We also have a series of higher highs and higher lows coming out of that base, and we're back above the rising 30-week moving average. We're back above the rising 10-week moving average. So all in all, really constructive price action from QQQE that shows that market breadth is not as bad as many would like you to believe. We can also see that off the lows, this is up 26%. So it's a bit disingenuous to just say that only a handful of stocks are rising when we can see that many stocks within the NASDAQ 100 are doing well right now. And so all in all, very constructive action. We can see that we pulled back recently. We had 4 red candles in a row. So basically, went down for a month, but it pulled back into this rising 10-week moving average, bounced off that. And now we're having a really strong weekly candle. We're up about 2.8% on the week so far. If it can close and break above this level and break out to the highest level since August of last year, that would be really bullish. And I think that would, put to rest a lot of concerns that the market is just being driven by a handful of stocks, because we're starting to see it in a lot more different areas right now. But of course, having said that, while we are seeing strength in more and more areas, what's really driving the market right now is the technology stocks. So this is the tech ETF XLK. We're looking at this one to start off our sector focus, because tech is the biggest, most important sector in the S&P 500, makes up 26% of the S&P 500 roughly. We can see just really positive bullish action out of XLK. Also bottomed in October of 2022, has put in a series of higher highs, higher lows coming out of that base, broke the downtrend that it was in. 30-week moving average started turning higher back in March. Rising 10-week moving average has been acting as support. And most impressively is we're breaking out of this base. So we can see that this huge rounded bottom acted as a base. We could have came up into this higher time frame resistance level, which dates back to January of 2022 and got rejected, but we're breaking out with authority. So as long as tech stocks are behaving this way and driving the overall market, it's harder for me to get really bearish on the S&P 500, especially the QQQs, which is more heavily skewed to tech. So overall, if tech's looking like this, it's hard to get too bearish. We're also seeing a strong rebound in the communication stocks, and this has been driven by stocks such as Meta and Netflix had a huge day today, so that's been helping. And similarly, we're coming out of a huge base here above the 30-week moving average, which is something I use to identify the primary longer-term trend of stock, or in this case, an ETF. Again, the rising 10-week moving average has been acting as support, and we're starting to break out and starting to flip this resistance level. We'll have to see how the weekly candle closes, but overall, really constructive action out of communication stocks. This is actually my top pick to be the best performing sector of this year. I made that call earlier in this year, or right around the end of last year, and my thesis was pretty simple. This was the worst performing sector last year, so I was just basically betting on a mean reversion trade, and we're seeing that play out right now. So overall, you got to be really encouraged by what you're seeing out of communication stocks. But we want to also look ahead and figure out what other sectors could join the party and help push this broad-based rally forward. One area that has my attention right now is the industrial stocks. So as you may or may not remember, industrial stocks were one of the first areas of the market to really rebound. So we can see we bottomed in September, and then we had a huge, basically, went vertical rally for a few weeks. It broke this downtrend that it was in, and then since then it's just been trading sideways and consolidating. And depending on your perspective, you could argue that this is a diamond top pattern, and this is somewhat of a distribution pattern that's going to roll over. But I'm encouraged by the fact that we're holding above this this trend line break. So we're really just consolidating after a huge vertical move, which is perfectly normal for stocks, or in this case, a sector ETF, to build up energy before moving higher. And so I also am encouraged by the fact that we're back above the 10-week and 30-week moving averages, which are the moving averages that I use to determine more intermediate trend and longer term trend when looking at the weekly chart. So overall, looking pretty good. I could see, if this broke out to the upside, that industrial stocks could emerge as a source of leadership again. One thing that's worth noting when looking at these industrial stocks is they're only about 7% off their all-time highs, while communication stocks is much further off their highs. And I think tech is about 10% off their highs. So industrials have really been leading the market in terms of how far they are off their all-time highs. I know it might not seem like that because they've been trading sideways for a few weeks, but that conversation could really change if we break out to the upside. And XLI is one of the first sector ETFs to hit new all-time highs. So definitely an area of the market you want to watch. We could see some rotation into that area if tech starts to cool off a little bit. So keep an eye on industrials. The last sector I want to discuss is the consumer discretionary stocks. This area of the market has caught my interest because if you go on Twitter or you turn on your television, you'll probably hear reports about how the consumer is dead, the consumer's tapped out, they're burning through their savings, or they're tightening their purse strings. And so you'd think that consumer discretionary stocks would be hurting because the companies that make up the consumer discretionary ETF XLY are companies that sell things people want rather than need. So they sell apparel, clothing, electronics, vehicles. So if people were really starting to cut back on their discretionary spending, it would impact these stocks. But we're not seeing weakness out of XLY right now. We're starting to see some really constructive action. So here I did draw the inverse head and shoulders pattern. We can see that it's broken out of that, as many stocks and ETFs have recently. So we're back above that downtrend line that began in November of 2021. So that's a big positive. We have this little mini base here that you can see a little clearer on the daily. So we can see that, we traded sideways for a little bit and we're breaking out of that. So overall, really constructive action here. And yeah, just like what I'm seeing, it kind of makes me think, differently, or makes me think twice about all these reports I'm hearing about the U.S. consumer being dead. I'm also encouraged by what I'm seeing from this ratio chart. So this is XLY versus XLP. So this is the consumer discretionary stocks versus the staples. And we can see that consumer discretionary stocks we're trading in this tight wedge for a while. We've broken out to the upside quite aggressively this week, which means that consumer discretionary stocks are outperforming staples. And if the market were about to roll over right now, or the economy was about to enter a really brutal recession, I don't think you'd be seeing this sort of price action. I think we'd be seeing a rotation out of discretionary stocks into staples, but we're seeing the opposite right now. So this sort of rotation that we're seeing right now is the kind of rotation that you would see in bull markets. Rotations are the life force of bull markets. It's what keeps them going, essentially. So overall, really constructive action we're seeing from discretionary stocks on a relative basis as well as an absolute basis. Another consumer discretionary chart I want to look at. So this is RCD. This is the equal weighted consumer discretionary ETF. So it just gives us a sense of how the overall industry is doing with regard to participation and breadth, similar to QQQE for tech stocks. So when we look at this chart here, we can see this is actually even more bullish than the XLY chart because its bottoming process began way back in June of last year, and came back and put like a double bottom in pattern in here, but it was just began its bottoming process ahead of schedule before the indexes did. So I like to see that. That's something I look for and when I'm looking for leading stocks and areas of the market of the potential lead. And so now we can see that we're starting to rise and come up against this downtrend line from the all-time highs. But we also have strong support off the lows, and it's essentially forming a really tight triangle. And these tight triangles, when price action of a stock or an ETF gets really tight, it's often before a big move. It's basically the market's way of building up energy, and it's an asset's about to explode in one direction or the other. And I'm leaning to this breaking out to the upside. I say that because just the longer term price structure is bullish. We're above this rising 30-week moving average. We're above this rising 10-week moving average, which has acted as support on the prior pullback. And so, overall, just really constructive action. And when you couple it with what we're seeing in XLY and the XLY versus XLP relative chart, it all leads me to believe that consumer discretionary stocks could be an area that money starts to rotate into in the coming weeks, especially if tech stocks, which have been on a huge run lately, if those start to cool off and maybe come back down and test that support that they just broke out of. I think this could be an area that catches some inflow. So definitely keep an eye on discretionary stocks. One last piece on the consumer discretionary angle. So as you can tell, I'm really fascinated by just the price action, what we're seeing in this area of the market, just particularly because it doesn't jive with this popular narrative of the consumer's dead. So I think it's interesting to see what price is telling us versus what headlines and people on podcasts are saying. So here we have Booking Holdings. This company owns Booking.com. I want to say they also own Priceline.com and a few other travel aggregators. Basically they're a one-stop shop for if you're trying to book a flight, a hotel, or a rental car. I think they also own Open Table. So, diversified business, really, really exposed to the consumer. So we're talking about vacations and renting cars and going out to restaurants, which, if the economy was about to fall apart or the market was about to fall apart, I don't think we'd be seeing Booking breaking out to new all-time highs. But that's exactly what's happening here. Super bullish move this week. I mean, it's hard to argue with this chart unless we come back down and this chart just completely reverses course and it was a false breakout. Then maybe we could be concerned about the consumer. But right now, this is putting a lot of those concerns to rest. This is just really bullish price action, and I think it's really telling. Really telling chart that says a lot about the consumer strength right now. That's you're not hearing about in other places. So I just wanted to share that chart with you, and as well as the other charts we shared today, the sector ETFs and our little discussion on breadth. But yeah, overall, I hope this video was helpful for you and, help you see some of the bigger picture stuff that I'm looking at right now. But anyways, that's it for today. Hope you guys enjoyed.